Hi, hello friends. Welcome everyone to Precision Price Action Pro Trader series. The topic for today is why should we avoid hourly candles? So why should we avoid hourly candles? Friends, there is something called tick data. I hope every one of you know it. For every move, every second, there is a open, high, low, close. Many times price moves within a second also. A second candle is there, a minute candle is there, 5 minutes, 15 minutes, 30 minutes, hourly, daily, weekly, monthly, quarterly, yearly candles exist. Alright. So 60 seconds of tick data adds up to become 1 minute candle. And every candle in every time frame tells a story. Because price action is all about storytelling. Among all the candles, there is one candle which is slightly controversial, particularly in the Indian markets. That is hourly candle. I always call hourly candle an incomplete candle. Please come, let's deep dive into the story. Indian markets run from 9:15 to 3:30. That is officially 6 hours and 15 minutes, which works out to about 375 minutes of trading. You will see about 375 1 minute candles in the entire journey. Alright? Yeah. Now, if you divide 375 by 60, you will get 6.25, which is 6 hours and 15 minutes. It means a day will have 6 hourly candles and a partial hourly candle, which is a 15-minute candle, which is not a hourly candle. It is a partial candle because it is less than 1 hour. Okay, and that extra 15 minutes creates the incompleteness. I always prefer playing candles which the masses don't use generally. Which are the candles you use? 5 minutes, 15 minutes, 1 hour? I never use them. I use very abnormal candlesticks time frames. For example, I have used 13 minutes, I have used 7 minutes, I have used 9 minutes, I have used 17 minutes candle also. Do you know why? It is not that these candles are special. It is because these candles are less used. The reason why candles are less used is because 99% of the people use the standard candlesticks. Very few people go out of the box, use something which others don't use. When you use something that others don't use, you will be slightly away from them. I'll give you a very, very simple example. Imagine a fisherman. A fisherman is going in the sea to catch fish. Where will he stop the boat? He will stop at a point where there is maximum fish roaming around. He will never put his net at a place where only 1 or 2 fish is playing. He can see that fish, but he will not use his net. Why? The concept is ROI. His return on investment is less to go and trap those few fish. However, he will go to a place where maximum fish exist. The same thing holds good here. Institutions will seek liquidity. In the process, institutions will hunt retail traders where they are trading in plenty. Your 50-day moving average, 200-day moving average, RSI 30, these are all levels where retail traders are available in plenty. That is the point where maximum liquidity exists. Wherever there is maximum liquidity, institution comes and play manipulations to trap retailers and take away their levels. That is why you need to use 7 minutes, 9 minutes, 17 minutes, not because they are secret formulas, it is because it is less used and the probability of you escaping an institutional trap is comparatively less. I am not telling they are secret indicators and you use that secret formula, you will make a fortune. No. All I am telling you is it is not mass mentality. Wherever there is herd mentality, mass mentality, you should stay away from them. At least you will not hit your stop loss. Okay. Now, I strongly prefer 25 minutes or 75-minute candles instead of hourly. Why? You divide 375 by 25, you divide 375 by 75, you will get round numbers. You will get complete candles. You don't get any partial candles there. So, instead of hourly candles, I strongly recommend all professional price action traders to primarily focus on 25 minutes or 75 minutes, as the case may be, depending upon your choice. And remember the fact that the most common time frames are always dangerous. Think in uncommon ways. In many cases, when I talk to professional traders, they ask me which moving average is better to use. I tell, use anything other than 50, 100, 200. I generally tell people use, you know, 33-day moving average, 57-day moving average, 133-day, 233 days. Take the Fibonacci numbers which are very close to 200, 250 or 150 levels. They are good. Why? 99% don't use it. That's it. Not because they are a secret formula, it is because maximum herd will not use it, hence you use it. Probably you can escape a stop loss. Okay. With this, we successfully come to the end of this video on the reason to avoid hourly candles. In the subsequent topics, I will come back and give you much more insight into deeper aspects of price action. Until then, signing off, Ashok Devanampriya from Traders Gurukul. Thank you.